Tesla plus SpaceX, merger or myth? The Tesla-SpaceX merger story just moved from Wall Street speculation to something much harder to ignore. Elon Musk says the two companies have more and more overlap. A Wall Street Journal report said Tesla advisors were evaluating what a possible combination could mean for the company's China business. Musk then called the China separation story absurdly fake news and said it had never even come up in discussion. So is a merger actually happening? The honest answer, as of August 8, 2026, is no confirmed transaction. There is no announced merger agreement, no exchange ratio, no joint proxy, no closing timetable, and no regulatory approval. But there is now enough real integration to understand why investors keep asking the question. Start with what is confirmed. SpaceX acquired XAI in February. That was a real merger, supported by corporate filings. Tesla's previously announced $2 billion investment in XAI converted into SpaceX common stock. Tesla's first quarter filing says that stake represents less than 1% of SpaceX. Tesla also says its other transactions with SpaceX during the quarter were immaterial. That matters because the rumor is not being built from nothing. Tesla and SpaceX already exchange technology and services. SpaceX's own European prospectus says the relationship evolved after Tesla's XAI investment became SpaceX equity. The prospectus describes the companies as evaluating future strategic opportunities and identifies Terafab as an expected collaboration. Terrestrial chips for Tesla vehicles and Optimus robots, and space-optimized chips for orbital computing. In other words, convergence is real. A legal merger is not. The bull case starts with a single integrated physical AI stack. Tesla brings batteries, energy storage, electric drivetrains, autonomy, robotics, high-volume manufacturing, and a global vehicle fleet. SpaceX brings launch, satellites, communications, government contracts, and the possibility of compute infrastructure in orbit. Put those capabilities under one capital and engineering umbrella, and the combined company could theoretically coordinate chips, energy, robots, factories, connectivity, and orbital data centers faster than two separate organizations negotiating every project. That is the vision behind the excitement. Musk told investors there was more and more overlap, while also saying any discussion of combining the companies would require the appropriate process. Analysts have described deep operational integration and possible synergies involving megapacks, proprietary chips, AI training, and fleet management. But the bear case is not a footnote. It may be the whole deal. First is valuation. Tesla shareholders would need to know exactly how many shares are being issued, who receives them, and what independent valuation is assigned to SpaceX. A merger can create strategic value and still destroy value for one side if the exchange ratio is wrong. A headline premium is not the same thing as fair economics. Second is dilution and capital allocation. Space, artificial intelligence, factories, rockets, satellites, and autonomous vehicles are all capital intensive. Combining them does not make those bills disappear. It could give the group a larger funding base, but it could also make Tesla shareholders responsible for risks and spending cycles they never chose. Third is governance. Musk leads both companies, and Tesla already classifies SpaceX dealings as related party transactions. Tesla says those transactions are handled under its related person policy. SpaceX's filings describe audit committee review for covered related party deals. In any serious merger process, investors should look for an independent special committee, outside advisors, a fairness opinion, detailed conflict disclosures, and a vote structure that protects unaffiliated shareholders. Fourth is regulation, especially China. SpaceX is deeply connected to United States government and defense work. Tesla operates major manufacturing and commercial businesses in China. Reuters reported that J.P. Morgan viewed regulatory approvals, particularly in China, as a practical bottleneck. The Wall Street Journal later reported that advisors had discussed a spin-off, sale, or closure of Tesla's China business before a potential merger. Musk denied that discussion happened. Until there is a filing, both claims belong in the category of disputed reporting, not transaction fact. So what would turn this from rumor into reality? Watch for 5 things. 1. An 8K or formal press release naming a transaction. 2. An S4 registration statement or joint proxy explaining the exchange ratio. 3. Independent board committees and a fairness opinion. 4. A detailed plan for Tesla China and SpaceX's government contract obligations. And 5. A closing timeline conditioned on shareholder and regulatory approvals. Without those documents, a merger is a thesis, not an event. My investor takeaway is simple. The companies are already becoming more strategically entangled. Tesla owns a small SpaceX stake. SpaceX owns XAI. Terafab creates a plausible shared manufacturing layer. The engineering logic is stronger than it was a year ago, but strategic overlap does not answer the hardest questions: valuation, dilution, governance, regulatory approval, and who absorbs which risks. Those details determine whether a merger creates value or merely rearranges Musk's empire. For now, the cleanest conclusion is this: the convergence is real, the China report is disputed, and the Tesla-SpaceX merger remains unconfirmed. Treat every headline as a scenario until the companies put a binding agreement in an official filing. This video is for information and education, not financial advice. Some visuals are clearly labeled artificial intelligence concept visualizations and do not depict actual events.